Hold onto your hats, because Arthur Hayes is doubling down on his jaw-dropping Bitcoin prediction, and it's not for the faint of heart. While most analysts are hedging their bets, Hayes boldly claims Bitcoin could skyrocket to $200,000 to $250,000 by year-end, despite the recent market turmoil. But here's where it gets controversial. He insists the October-November crash to $80,000 was the cycle bottom, driven entirely by a trillion-dollar liquidity drain, not the start of a bear market. And this is the part most people miss. Hayes argues that the Federal Reserve's quantitative tightening, QT, is nearing its end, setting the stage for a liquidity upswing that could propel Bitcoin to unprecedented heights. During his November 26 appearance on the Milk Road Show, Hayes stood firm on his prediction, even with just weeks left in the year. "I'm going to stick with it," he declared, adding, "If I'm wrong, it doesn't matter. I'm long, I'm still happy either way." But what's really stirring the pot is his take on ETF outflows and Digital Asset Treasury, DAT, weakness. While many saw these as signs of institutional retreat, Hayes claims they were misunderstood. He argues that Bitcoin's recent dip simply reflected a liquidity reset, and once new liquidity becomes visible, Bitcoin will accelerate. Here's the kicker. Hayes believes Bitcoin's price isn't driven by halving cycles, as many think, but by liquidity, politics, and the US business cycle. And he's not alone. Analysts like Quinton Francois echo this sentiment, predicting 2026 as the year the fireworks truly begin, with QT ending, midterm elections, and a booming economy for re-election purposes. But let's dive deeper into the ETF frenzy. Hayes claims retail investors got it all wrong when they panicked over ETF outflows. He explains that the so-called institutional bid was actually a basis trade, with firms like Brevan Howard and Goldman Sachs exploiting a spread between ETFs and futures contracts. They were making 7 to 10% per annum on that trade, he said. When funding rates fell, these players unwound their positions, causing ETF flows to turn negative. But it wasn't institutions dumping Bitcoin, it was just a funding strategy adjustment. Now, here's a thought-provoking question. Are we misinterpreting market signals, or is Hayes seeing something others aren't? His confidence in a liquidity-driven rally hinges on the commercial banking system stepping up, with early signs of renewed lending and political plans for credit-fueled industrial growth. But markets remain skeptical, questioning how and when another $10 trillion in liquidity will materialize. So, why is Bitcoin stuck around $90,000 for now? Hayes points to uncertainty over the new U.S. administration's credit creation plans. Until political promises turn into concrete programs, markets are hesitant to price in a liquidity surge. But once they do, Hayes predicts risk assets like Bitcoin will soar. What do you think? Is Hayes onto something, or is he overestimating the impact of liquidity on Bitcoin's future? Let's hear your take in the comments. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research and consult with a professional before making investment decisions.